Welcome back to the Danko Financial YouTube channel. Today we are talking about my price targets for both the end of 2022 and 2023 on Snowflake. That's stock ticker SNOW. Now before we begin, as always, this video and all videos on this channel are for entertainment purposes only. Please, I strongly urge you and recommend that you do your own research and or consult a financial professional before touching any of your own individual or personal investments and making decisions from there. Now, to get right into this video, like I said, we are looking at a price target of Snowflake. And as you can see, just from the most recent charts, namely the past 5 days as well as the last month, it hasn't been overly amazing for Snowflake. I know in the past month we only see a drop of a little over 3%, which doesn't look bad on the surface. However, at one point they went from 400 all the way down to 310 or 311 looks like there, but a very, very large drop as a whole. The only reason that this number is not as low as it should be as what it was before is because their most recent quarterly report actually bounced this stock back up to 360, a very strong jump that following day after the after hours report. But in any case, like I said, the past month here has been pretty nasty for Snowflake, just as a overall market sentiment. The stock as a whole and this industry in particular, the cloud computing stocks, have not exactly been performing well over the past month. Now, one thing I do want to highlight, and this actually plays into the price movement, again, we see this massive jump here, is due to the quarterly report, which is where we are going to begin with this price target estimate. Now, when I look at a price target for a company like Snowflake, a young company that is pre-profit, they don't have a record of profit just yet. I like to look at a price to sales, or the price to sales ratio of the company, and essentially what that is the stock price, more or less, versus the revenue of the company. I'll show you the calculator that I use, and it'll explain it more in depth if you're unfamiliar with the price to sales ratio. But in any case, I do like to take a look at their price to sales ratio, a valuation metric, and compare it to similar stocks in their particular industry. Namely, in this case, which I will again mention in a little bit here after we take a look at what I am projecting from the price to sales ratio, what I'd like to see from the price to sales ratio. Those similar stocks will be ServiceNow, stock ticker NOW, Workday, stock ticker WDAY, and Salesforce, which is the stock ticker CRM. Now, getting right into the quarterly report, we look at a CNBC basically story, or not even story. CNBC basically they posted obviously the key, the highlights of the quarterly report, which allows us to quickly look, and I mentioned this in my previous video, at their 2022 revenue estimates, which are at, if we look on the high side, 1.131 billion projected for 2022. Now, taking that number, it's very easy for us to go right over to the price to sales ratio calculator, and we can look and go ahead and input all this information, as well as the number of shares outstanding, which is simply something that you can look up online for Snowstock. It will pump out the sales per share, and then from there we can test out various price per shares, and that will generate a price to sales ratio for us as a whole. Now, I'm going to tell you right now the range that I'm looking for based on the other stocks in this industry is essentially between 10 and 15 really right now, and even that may be a little bit overvalued. But as a whole, assuming that 10 to 15 price per share ratio, and I think you guys will be, price to sales ratio, I think you guys will be surprised on the price per share that justifies a adequate or realistic price to sales ratio. So I'll go ahead and put in here, like I said, if we're looking at between 10 and 15 for a price to sales ratio, the number will come up here. If we type in 50, we look and we see that is in the middle of the range. So first and foremost, obviously not what a lot of people are expecting. They don't want to see a massive drop from now to the end of 2022. Keep in mind that this is essentially intrinsic value, which more or less means that this is what I think is the fair value. Actually, probably slightly less than this. I would probably venture to say maybe 40 would be, where I'd say is fair value, between 40 and 60, maybe 50 to 75. I mean, a little bit of a leeway on that, a couple factors considered. I don't necessarily see that as my estimate. I see it basically as the intrinsic value, and knowing that I price in a premium because it's a growth stock that is young and that has lots of room to grow. And then I see essentially the market as a whole. I understand the market's current situation. Now, my price target is, as you can see here, pulling up this document, assuming the high side of their revenue guidance for 2022, the intrinsic value, so in this case, I'll say it's essentially between 50 and 75 per share. My estimate by the end of 2022 is going to be under $175 per share. I'm assuming likely that's between 125 and 150. Now, I forgot an L there. Whoops, sorry about that. Now, why do I provide under 175 and then between 125 and 150? Well, it really depends on the market at that current time. So it depends on the situation, how the market reacts to the Fed continuing to pull back on things like interest rates. So essentially rising the interest rates depends on the bond yields. And overall, it depends on where the market is at in terms of, like I said, the response to that, as well as to hyperinflation and those various changes. And if we get more news on any variants or just general news as a whole, whether that's global or domestic within the U.S. So as a whole, a lot of things can change. Now, one thing you may notice if you're looking at both these price targets, you'll see that my price target for 2022 is actually higher than it is in 2023, which doesn't seem to make much sense because, as you can see here, I've noted that this is assuming a $1.98 billion revenue figure versus a $1.13 billion revenue figure. So again, expecting this in 2022, expecting this in 2023. Why is my estimate lower in 2023 than it is in 2022? Well, I'll tell you. So I believe that the price, it is my prediction that the price will be closer to the intrinsic value in 2023, because I think by the end of 2023, the market will have fully adjusted to the pullbacks by the Fed. Therefore, I do believe that the prices will be a lot closer to their intrinsic values. Therefore, there won't be much variance. It actually may dip even slightly lower. If you look at the overall market sentiment, especially in times like the dot-com bubble, you can see that the stocks go from highly overvalued to undervalued, only to then come right back up to, fair value, or eventually, over the course of the next 5, 10, 15 years, back to overvalued. It's the cycle. It's the way that the market works. But again, like I said, I'm expecting this under 175 mark, and then for 2023, I'm expecting under $100. Again, assuming nearly $2 billion in revenue on the stock. So another thing I will mention, just as we look over here at the price movement on the stock itself, if we look at, I believe, so it's the year to date, we can actually see that this year it dipped under 200. It actually dropped down to 188, about $190. Now that's really off no news. A slight market pullback, a correction, if anything. I would not necessarily say a crash in my own eyes anyways. But this was off essentially like a drift of the market over the course of essentially mid-year, responding to economic data and so forth. Various little pullbacks, new variants, vaccination information and details. But it drifted down to 190, pretty easily, from this, low 300 range. So when the market really and truly does react to the market pullbacks, the Fed pullbacks, on the interest rates, especially for a young company that needs to borrow the money, they'll likely look into one of two things. Either that will be stock dilution, so they will offer more shares, therefore diluting the stock as a whole and the price, or they will look to borrow money, but likely they won't, only because of interest rates rising significantly. It'll be tougher for them. I won't say they won't borrow money, but it'll be tougher for them to borrow the money. So Like I said, again, I don't think it's unrealistic to easily see a price under 200, even shifting once we get the true crash down to that 100, and under range. Okay. So again, like I said, I don't believe that by 2022, the stock will be at its rock bottom. I do believe by the end of 2023, at least during 2023, we will see a nearing, if not at bottom out point. Okay. Now, where did I get this 1.98 billion in revenue figure? Is that something that I just made up? No. So if we head over here, we can look at Yahoo Finance. This is Yahoo Finance. We can actually go just from a standpoint of, so what you guys can understand where I pull this information. We can look up the stock ticker or the company, and we can scroll over to analysis. We click analysis, and we look, scroll down here, and we can see revenue estimate there. And from there, I like to look at the average, which in this case, the average for current year 2023 is 1.97 billion. So 1.97, 1.98, around there. Essentially, you can even round up to 2. But when we put that into the price to sales ratio calculator, let's just say for namesake, we assumed that it was 2. So we'll change these to zeros. We will see that at a price of around, let's say 70, we're getting a price to sales ratio of, again, a little over 10, which would be in the low end of what we're expecting. Honestly, it could go lower than that. The current price to sales ratio of Apple, I believe, is around 7. And I know that Microsoft is actually a little bit overvalued at 14. So even in that case, somewhere between there, I think is highly realistic. And especially given the crash, the valuations of both of those will go down as well. Just that's food for thought to consider. Now, I want to go ahead and address right off the bat, because I know a lot of you guys will contest this, the comparisons, but ultimately what I want to contest is the growth factor aspect that a lot of people will be, claiming should be considered in this price target, and why this price target is outlandish. Well, if we scroll down here, first and foremost, we can see the comparisons of these 3 stocks, same cloud company, computing type stocks. The price to sales ratios of all of these, right? We see ServiceNow is pretty overvalued in that over 20 price to sales ratio. Salesforce is a little under 10, and Workday is at about nearing 14. Compared to Snowflake, which of course right now is about 100, which is clearly in and of itself insane. However, we can account for the fact that they are doubling in revenue, which means that their price to sales ratio is going down. So next year, again, they're projecting about a double, 100% gain in revenue. All right. So, giving them credit in that regard, do I think the price is at all, acceptable? No. But the price to sales ratio would make sense for a young company to have a bit of a higher one, not nearly at this level, but of course keep that in mind. Now, again, like I said, addressing the growth element or growth aspect factor. This is something that I want to highlight, which I think is really important to take into account. So we can see the growth over the last 3 years. This is in terms of revenue. We can see that Snowflake has grown a whopping 780% in revenue in the last 3 years compared to ServiceNow, which is about at 100%, Salesforce at 77, around 75%, and Workday at 65% there. So, specific note on these particular numbers, we have to realize that Snowflake is still in the under 1 billion revenue range. So, for them to grow from 50 million to 754 million, let's just say for namesake, is a lot easier than a company like, say, Salesforce growing from, let's say, under 1 billion or at 1 billion to to upwards of 12, 13, 14 billion. I mean, in the last 3 years, they've increased their revenue by 10.26 billion. Now, while that this particular percentage may not represent that magnitude, we do have to take into account that because Snowflake's a smaller company, it's easier for them to grow and to show that they have a high growth rate. When in reality, when they start to hit these billion-dollar numbers, it will start to get harder and harder for them to not only compete with these guys, but also to continually grow by 50 to 100%, every year in terms of revenue. So keep that in mind. That's something important that I think people aren't really taking into account, is that they're a small company, so it's easy for them to promise big growth. But big growth cannot be promised consistently. And honestly, because this company is so young, it's important for us to evaluate its performance over the course of 3, 4, 5 years plus to really see where it's going. Now, what we can see this, again, insane growth here over the last 3 years, but once it gets over 1 billion to 2 billion, will it go from 2 to 4? Will it go from 4 to 8? Those are questions that we wait to see that are, that will remain unanswered for the time being. But again, points to consider. Now, lastly, I know, like I said, I specifically mentioned that this is a price to sales ratio. Another metric that we could look at for valuation would be price to earnings. Keep in mind, again, the price to earnings are not necessarily useful for a company that does not have any profit. However, just to give you guys an idea as to where they are at in terms of earnings per share, analysts are expecting that by 2023 they'll be at about negative 0.08. So about I think it's, 8 cents per share, which is obviously in the red, not in the green. That would be their earnings per share. If we were to assume, let's just say in 2024 they became profitable just barely, let's just say for namesake, their earnings per share are 3 cents per share at a price of, let's just assume, even like looking at what I said in terms of the lower end range of 2023, so back into 2023 into 2024, seeing a price per share of 70, we see a ginormous price to earnings ratio. So that's another thing to consider, that Snowflake is not very profitable at the moment. Obviously, again, they're a young company. It's to be expected that they aren't profitable immediately. However, their revenue is only one aspect, right? Revenue is only one element of the company. They need to also make money in order to continue to be a useful and obviously successful company. So keep that in mind, that right now they are actually spending a lot of money on growth and a lot less money on essentially maintaining the service. Doesn't mean the service is dropping. They actually have a lot of great feedback, and you can look at that in their quarterly reports. You can look at that on their website. They note a lot of the metrics on their returning customer rates. But as a whole, you do have to realize that it's important for them to also keep cash on hand, and it's important for them also to ensure that the revenue that they're making, and as they increase in revenue, that we start to see a sooner shift to that profitable range, that profitable zone. But if by 2024 they're only at 2 cents or 5 cents, per share, so the earnings per share are only 5 cents, let's just say for namesake, right, just barely skidding over that zero mark, it is important to realize that, again, that price to earnings ratio is absurd. A fair price to earnings ratio would be around 22,300. Like I said, like I noted here, would be outrageous. Even if for, in some, way, shape, or form, they were able to get 10 cents, an EPS of 10 cents by 2024, we'd see a massive price to earnings ratio, number there. So I assume that they will cut back a little bit on the marketing and stop spending so much as they get higher and higher in revenue and as they start to really build themselves as a company. But again, just a food for thought item to consider. So that concludes the video. Again, guys, I appreciate you guys watching. If you liked the video, please make sure to like and subscribe. Again, my price targets are by 2023. I am expecting a price per share that is somewhere between 125 and 150. Just put per share here, so we are on the same page with that. And again, my estimate for 2023 would be likely somewhere between $70 to $90 per share. Again, much closer to the intrinsic value than I believe will be the case in 2022. That being said, of course, I have been surprised before, and it could be lower. I don't see it being higher. Again, I think under 175 is very, very, very realistic. And in 2023, under 100, depend on the clip that the market reacts. But if they react the way that I am anticipating, I think under 100 will be essentially a given. So again, thank you guys. I appreciate the time. And as always, I will see you in the next video. Take care.